Welcome to the Winning Strategies podcast with Mike McGlothlin. This podcast is sponsored by Ash Brokerage's Retirement Division, where we help advisors help clients retire more securely. At Ash Brokerage, we know that you want to be an innovative financial planner. Many planners feel frustrated by the process of placing guaranteed income into their client's portfolio. At the same time, clients feel anxious about the chances of running out of money and income during their retirement. This puts the planner at a crossroads of making sure they run their businesses efficiently and at the same time meeting the client's best interest. We believe that every client deserves to have a retirement free of worry that they will not run out of money. We understand the anxiety of planning for a complex need like retirement, which is why we will work with over 2,000 financial advisors and help over 13,000 of their families retire more confident in this year alone. Our guest today is Don Graves, RICP. He is the president and founder of the Housing Wealth Institute and an adjunct instructor of retirement income at the American College of Financial Services. He is considered one of the nation's leading educators on incorporating housing wealth into retirement income planning. Don has been quoted in Forbes magazine, featured on PBS-sponsored shows, and recognized as one of the American College's 11 retirement income alumni you need to read. He is sought after professional speaker, and his workshops are helping advisors across the country to grow their practices. So Don, thank you for being with us on the show today.
Thanks, Mike. Glad to be here.
Let's start off with kind of a little bit of a general question. Why don't you just tell us a little bit about the growth of the HECM strategies really over the last 5 years?
Sure, Mike. For folks who may not know, the HECM stands for the Home Equity Conversion Mortgage, and the common name is reverse mortgages. And it's been around for 30 years. In 1988 until 2018, when we're recording this show, it's 30 years old. And through that time, it's certainly gone through its changes and transitions, hiccups and hurdles. But 2013, 15, and 17, that's really when the financial advisor community began to take a second look at this. The program made some changes, made some structural changes, primarily to make it a stronger program. Now, they did that. One of the structural changes is you want a program to be sustainable. Therefore, they were giving too much money available in the early days. It was just too much to the borrower, and HUD finally said, you know what, we're making too much available too soon. So they throttled back the amount available so the program would be sustainable. So a stronger program. And then they also said, we want to have a better match for the borrower. And so in doing that, they had some overlays that said, let's make sure the borrower has enough residual income to meet their monthly obligations, and let's make sure they've been a good credit citizen on the basics, primarily paying their taxes and insurances on time. And then there were some spousal protections and other things added, but primarily the program was strengthened, and then the kind of borrower matching was strengthened as well. And that's really given the program a real boost.
Talk a little bit about the new underwriting requirements. What's the maximum home value and age requirements? And then we'll talk about the line of credit growth factor in a little bit.
Sure. The original intent of the reverse mortgage, which started in Europe more than 100 years ago, here in the United States in 1961 as a private program. And the federal program, as I just mentioned, came around in 1980. So the original intent was to help sustain what was going to be a longer retirement. And how do we have, what resources do retirees have to sustain that? Well, most retirees had a home to sustain that. So the intent of the program was sustaining a longer retirement. So originally, I would say it was designed for the kind of the moderate income borrower. Over the years, particularly after 2009, we had a more affluent borrower beginning to look at the program. And so the lending limit now is $679,650 for the HECM reverse mortgage. But there are now several jumbo reverse mortgages that have come back into the market with loan values up to $5 million. So for someone age 62 or better, that's one spouse has to be 62. The other only has to be age 18 or over. They have a home, and the home value, depending on which program, can be up to $8, $9, $10 million. They can access one of the reverse mortgages to begin incorporating into their financial plan.
Great. Yeah, with that jumbo mortgage, that puts the entire population at as an opportunity within the market. Don, you and I have talked about this frequently over the last 3 or 4 years, but what do you think are the reasons why advisors have started using HECMs as part of their income planning strategies?
Sure. And I remember I've been doing this, Mike, coming into 20 years in some way. And in the early days, you would mention a HECM reverse mortgage to an advisor, and they would just laugh at you. I remember one fellow said that must be the saddest thing in the world to have to work with poor, destitute widows. Now, being from Kentucky, I wanted to punch him in the mouth, but I refrained from doing that. But there's really been a shift that's happened. And a lot of that began in 2011 and 12 when MetLife, Mature Market Institute, began writing about the role of reverse mortgages with an aging population. And then the first article that came out in the Journal of Financial Planning was written by Dr. Barry Sachs and his brother, called Reversing the Conventional Wisdom. FINRA, up to that point, had said reverse mortgages should be only used as the last resort. That was their written position. And two brothers, the Sachs brothers, took to task to say, where did you get that from? Is that true? And what they did was prove that that really was not the most efficient way to use a reverse mortgage at all. And that came out in 2012. FINRA changed their written position in 2013, and that's when we began to see, from 2013 onward, advisors beginning to take a second look at it. It began to trickle down. Why, is the question? Well, number one, there's a wider acceptance of the reverse mortgage strategy. FINRA had reversed their position. Institutions like the American College, or Texas Tech, MIT, Cambridge, all began to look at it and write research, and they were and say, you know what, this is a valuable resource. Earlier this year, 2018, there was a Housing Wealth Summit in Washington, D.C., sponsored by the American College, the Funding Longevity Task Force, and the Bipartisan Policy Institute. And Mike, they brought in all types of people from 8 o'clock to 1 p.m., and at the end of that 1 p.m., here was the conclusion. Reverse mortgages must be incorporated into retirement income planning. And so there's a wider acceptance. And secondly, and finally, there's a wider audience. So advisors have discovered that as boomers are coming into retirement, they're living longer, they've not saved enough, and they're highly indebted. And many of them carrying as much as 68% of mortgage or home equity debt into their retirement. And so they're challenged to say, our traditional tools for doing retirement income planning may not be sufficient. What does it look like to incorporate housing wealth? And as they're beginning to learn the strategies, the outcomes are fairly dramatic for their clients as well as for their practice. So that's why I think we have more advisors looking into reverse mortgages.
Certainly a lot of positive momentum in the financial services industry to look at that. I think when you take a look at some LIMRA data and Insured Retirement Institute data of the trailing baby boomer that's between 50 and 59 only has $130,000 set aside for retirement, there has to be another source of capital, another source of income to supplement that. And so I think that's where it can really come into play, and probably one of the reasons why it's growing momentum. You talk a lot about the benefits of HECM, and you've touched on them a little bit, but can you share with our listeners where some advisors have been using it to just simply supplement retirement income? And part of it that I'd like for you to talk about is really the tax benefits of using that HECM as part of the retirement income planning process.
Did you say the tax benefit?
Correct.
Okay, got it. Let me jot that down, because sometimes, Mike, you use the big words, and you know I'm from Kentucky, so I've got to pause every now and again and do that. You and I were together in Arizona a year or so ago, and then something very transformative happened after that meeting. I sent out an email to some attendees there, and a fellow wrote me back, and he said, Don, we're a registered investment advisory firm, and we manage the nest egg of a lot of people. We've done a lot of research, and we don't believe reverse mortgages to be a prudent strategy for any of our clients. And I appreciated his candor. And here was a transformation for me. From that day until today, I start every seminar, talk, webinar I give in response to that man's email. And I ask 3 questions to those who may be listening to this podcast who's an advisor or maybe even be a client. But the questions I asked him in response were, well, let me what percentage of your clients who are at or near retirement do you honestly think would have a need for a reverse mortgage? And typically advisors would say 5 or 10%. I said, thank you, that's very honest. Second question, what percentage of those clients would say they're 100% certain they'll have a great retirement? That's usually a pretty small number, 5 or 10% again. Here's the third and final question I ask advisors. I said, well, if there was a way, a proven resource, that allowed those clients to increase their cash flow, reduce risks, preserve assets, improve liquidity, or even add new dollars back into their retirement savings, what percentage of those clients would want you to tell them about such a resource? Now, Mike, that's usually 100% is the answer I get. And I said, exactly. I said, most of you listening and those who I teach would say, Don, of course, every one of my clients would want to know about increasing cash flow, reducing risk, preserving assets, improving liquidity, or adding new dollars back into retirement. And I say, now there's the impasse. You told me that 5-10% of your clients may need a reverse mortgage, but you also just told me 100% of your clients would want you to tell them what a reverse mortgage does. And it does those 5 things. So once advisors begin to say, wait a minute, you tricked me. I said, no, I didn't trick you. I just told you. I just unpacked it for you. And so increasing cash flow as a strategy, who doesn't want to increase cash flow? When you've got 50 to 68% of boomers coming into retirement with a home equity loan, line of credit, mortgage payment, second mortgage, that's a cash flow constraint. Now combine that with living longer and lower savings rate. If we can do something, just one simple strategy, do something with that, that will make a difference. About 2 years ago, Mike, I got a call from an advisor. He said, my client lives in a $4.5 million home down at the shore. He's a retired CEO of a large multinational pharmaceutical firm. And I said, great, he's looking at a reverse mortgage. And that didn't surprise me. And this advisor was with one of the large wirehouses. He says he's got $5 million invested with us, Don. That did surprise me. And so I asked the question, why is he looking at a reverse mortgage? Mike, here's what he said. He said, last year he spent $200,000 installing an elevator. He has now, and he borrowed money to do that. He's borrowed more than $2 million. His monthly debt service and principal and interest is about $20,000 a month. And the borrower now had $250,000 leaving every year. And the advisor said, I think we can sustain that from their portfolio. But there was a drain on the borrower in terms of their lifestyle and that burden. And they wanted to see if there was a reverse mortgage that could eliminate their monthly mortgage payment and create cash flow. Well, there was. It ultimately was not the right suggestion for them. I suggested they go in a different direction, but it was the right conversation to have. So one key strategy, Mike, is just looking and talking to your clients if they've got existing mortgage payment to ask them what would retirement be like if you didn't have to make a monthly mortgage payment. Either they'll say, it'll be great, and then they'll tell you why, or they say, we don't mind making a payment, and there's some things we can do there. The second strategy, and I'll stop with this one, is just setting up the reverse mortgage line of credit as a reserve, as a backup for you. Now, I know Ash Brokerage has done some research on that and establishing a reverse mortgage line of credit early in retirement. And some of your listeners may not know that a reverse mortgage can be taken as a lump sum line of credit or monthly payment. So, and the line of credit has a built-in guaranteed growth factor that cannot be canceled, frozen, or reduced as long as you're meeting the obligations of the loan. So, and it's growing right now at about 5.5%. Now, establishing that line of credit means that if you've got money in the market, and some people, and I'm not talking about the part that's maybe been moved over to fixed income, but the money in the market, if the market takes a dip, you don't want to convert or cannibalize those assets during the distribution phase, during the dips. If you've got a non-correlated asset, such as life insurance or a reverse mortgage line of credit, you can draw from that during the dips, allow the portfolio to recover. And the outcomes of that, and maybe you can speak to this, Mike, because you found that to be a pretty dramatic kind of outcome when you did that. What did you all discover at Ash?
Yeah, we did a study over 20 years, and we had a $2 million portfolio, a normal systematic withdrawal. And every time that the market corrected at year end, then we used a HECM for the income needed the following year. What we found in 50 different runs using 5,000 simulations per run was using a traditional systematic withdrawal, we ended up with a 26% failure rate. More than 1 out of 4 people would fail before the 20-year retirement goal. But when we used a non-correlated asset, using HECM for that 1 year of income, we reduced the failure rate to 2%, just 1 out of 50. So that was significant for us, and it was very eye-opening in terms of the use of the HECM strategy in just stabilizing the account. The other thing that I would like for you to comment on is we think that the line of credit is a great tool for the uninsured that is looking to shift the risk of long-term care. So we do recommend purchasing lines of credit and setting those up at age 62 and then letting that grow at the 5 to 5.5% so that when you get to age 80, you have this pool of money that, if I remember correctly, may actually be greater than the value of the home, but still accessible from capital. So can you kind of dig into that particular idea?
Sure, and I'm going to combine that with the kind of tax benefits of that. So one of the things that happens is the 5 major concerns of retirees: longevity, will my money last as long as I do? Lifestyle, will I be able to enjoy it or will I need to cut back? Liquidity, will I have access to tax advantage dollars when I need it? Legacy, how will I be financially remembered? But the last L is long-term care, the out-of-pocket expenses of healthcare. That includes just your traditional out-of-pocket expenses, which Fidelity said could be $280,000 in their most recent report, and then traditional long-term care, the things we think about, which could easily be $130,000, says the U.S. government, and more. So what do our clients do for that pocket of money they're going to need just for their health care? $200,000 to $500,000. Most people don't have a plan for that. And so establishing this line of credit early in retirement and letting it grow can do several things in terms of long-term care. And I wrote a whole chapter on it in my book, but it's absolutely powerful. So one of the things is self-insuring. Maybe a person cannot get traditional long-term care or even a asset-based kind of a life insurance or annuity, so they're going to self-insure. What a powerful way. If they have a $300,000 home and they set up a $120,000 line of credit, or whatever the number is, and that's growing at 5.5%. By the time they reach 85, the average age when people go on claim, you have something very significant. You've got a line of credit that has grown substantially. I don't have those figures in front of me, but if you had it, whatever, $120,000 at 5.5%. But secondly, with the reverse mortgage, you have something we call optionality. Optionality means that line of credit can be converted into a monthly payment at age 85. It can be converted into a payment that's 60 months or 5 years or 120 months. I just wrote an article Tuesday that we showed a client where at age 85, they were able to get $10,009 per month over a 5-year period because of something they did at age 65. And so that becomes something to really have a conversation about. Another thing, if you're doing long-term care and planning, is, Mike, the example I gave of just eliminating a monthly mortgage obligation. More than half of the population is going to come into retirement having that. Well, if you use the reverse mortgage to eliminate this payment of $500, $1,000, $1,700 a month, you freed up some cash flow. What can that be reimagined to do? Well, one of the things that advisors are helping their clients to look at is a traditional long-term care insurance plan, sometimes a 10-pay life insurance, where the liberated dollars that came from the mortgage replacement have now been used to replace the income for paying for those premiums. And so there are lots of ways that when you incorporate housing wealth into the conversation, into the long-term care planning conversation, you give yourself tremendous options. Now, because the dollars from a reverse mortgage are non-taxable, to be able to convert a reverse mortgage into a monthly payment, one of the things that we talk about is that if a client says, hey, I'm on the tax bubble, which means if I pull some money from my qualified plans or some more dollars over here, that's going to put me in an entirely new tax bracket. And we would say to them, let's look at the value of setting up a reverse mortgage monthly payment or pulling out some of those dollars from the non-taxable and keep you in a lower tax bracket. We talk about Roth conversions, that a person has some dollars sitting out there that they're thinking I may not need, but I don't want to give Uncle Sam whatever the future tax rate's going to be, but I don't want to pay the taxes on the conversion. We say, well, setting up a reverse mortgage line of credit, we can just roll those IRA dollars over in a single lump, but I would suggest doing it over a 5, 8, or 10-year period that the line of credit grows. We roll over some, we pay the taxes. So at the end of that 10 years, you've got tax-free dollars, and you still have use of the line of credit. And so many things we can talk about, Mike, in so little time. And I just have a new version of the book where I have incorporated did a whole chapter on Roth conversions. I took out a chapter and added that because it had become so powerful. So thanks. That's a great question. Sorry for rambling on with that.
No, and that covered one of my last things that I wanted to touch base with you, because that HECM for purchase, one, it eliminates the ongoing debt servicing. And I just read an article last week that the highest segment of bankruptcies is now in the senior market. And we're having more and more people have mortgage payments and high mortgage payments take away from their style of living. So not only being able to do the HECM for purchase in terms of eliminating that debt service, but it's also a great way to get a retiree into a proper standard of living. So many of our retirees still live in the home where they raised their kids, 3 to 4 bedrooms, 2 stories. Now, as we age, we need to get into single-level homes and those types of things. So that's a great strategy to get into the proper living situation that matches your future lifestyle, and do so without the debt servicing. Would you add anything to that as well?
Most people don't even know what you're talking about there, Mike. When you say HECM for purchase, say, what is that? They don't know that you can use a reverse mortgage, your client, to buy their next home with about 60% down payment and have no monthly mortgage payment. They don't know that. And so that's one of the most powerful things that we can talk about, is that most people are living in a home, their children are not going to come back, and they don't want to mow, rake, have the expenses of it. And I say to them, if we could increase or add new dollars back into your retirement savings, but it may require you moving to your next less than best home, would you be open to understanding it? So simply stated, a client, a 70-year-old client, could move into a $300,000 home for about 60% down and have no monthly mortgage payment. So that means they can sell their home, maybe pocket $180,000, maybe more, and move into a new home, so you've got less maintenance, lower taxes, a better living situation, better floor plan, and it didn't impact there's no cash flow outlay, and you didn't have to pull money from savings. So the HECM for purchase is the fastest growing way that the reverse mortgage is being used in America, and it's the fastest growing. And the reason for that is, one, it makes sense, and two, it's adding new dollars back into retirement savings. And so to do that, and we can't cover all of it now, but it is a powerful resource, and one I think every advisor should be discussing with their clients, because you've got aging homes, you've got deferred maintenance, you've got all types of issues. And if we can do something with that housing asset to make it less burdensome and give them their best house for last, it's going to be a great conversation to have.
Don, I always enjoy talking with you. I always walk away with at least a few ideas, even in a short conversation like this. I love the idea of setting up a line of credit early. I talk about that a lot. Provides a great amount of leverage for retirees for long-term care and potentially using it as a non-correlated asset. Really like the questions that you gave to advisors, that I really think that they need to think about their client base with those 3 questions. You know, how many do they think need it? How many do you think would like to have 100% secure retirement? And then how many people would like additional cash flow without the risk and things like that? And finally, obviously, the HECM for purchase is a great opportunity to help many Americans. So thank you. Don has a new book available for our listeners. If you'd like more information on home equity conversion mortgages, you can go to www.housingwealthbook.com to look at information, download a free chapter, and order the book through Amazon if you'd like to see more on that site. As always, thank you for listening. I hope this information was helpful. Please feel free to send me feedback or suggestions on other relevant topics via direct message on my Twitter account. My handle is @McGSpeaks. Look for more upcoming shows on the Winning Strategies podcast. Don't forget to subscribe to our YouTube channel for Ash Brokerage. You will find more information on retirement planning and income planning ideas. Follow me on LinkedIn, and don't forget about our written blog through ashbrokerage.com. Thanks for listening and good selling.